What we see here on the screen is an all-weather portfolio. I have not envisioned an all-weather portfolio. This is from an investor named Ray Dalio, chairman of a very large investment fund, Blackwater. And he says yes. You can also keep it very simple and set up an all-weather portfolio that can withstand all storms. All storms mean a stock crash, bond crash, commodity crash, etc. So basically what you are trying to do is create a composition of different assets that complement each other in terms of diversification, but also in terms of correlation. Diversification is actually correlation, because if you have a perfect correlation of one, then two assets follow each other exactly the same. But if you have a correlation of -1, and for example the stocks go up while the commodities, which in this case have a correlation of -1, go exactly down, then they actually cross each other like this. And that is actually a bit the case with these assets. Gold is usually seen as stable, but in terms of, or during times of, economic growth, very strong economic growth, where for example interest rates are low, then gold is not a smart investment at all, because you can invest much better in companies. Moreover, within that sector of companies, you have different types. You also have value stocks. You have dividend stocks, or companies, I should say, but you also have growth stocks. And when interest rates are very low, then growth stocks, which are companies that grow very quickly but are not yet profitable, can attract cheap capital, grow even faster, and thus buy their own cheap growth. But in other phases, when interest rates are very high, it has a negative effect on as many stocks as on bonds. Again, not all bonds and not all stocks are affected, but it has a positive effect on gold, for example. The same goes for commodities. If inflation is high, commodities can actually experience a strong boom. So these assets complement each other. And Ray Dalio says yes, if you create the right composition, then it is an all-weather portfolio. It can withstand all storms. There are pros and cons. We start with the advantages. That is, of course, a lot of diversification. You can see it here in the portfolio. Actually, you have a very large portion in bonds, 55%. And he says, just buy the entire bond market. And the whole is not the right word, but rather a lot. Why? This is a concrete investment. You can buy this, and the ticker is BNWD. And this fund actually means that there are more than 16,000 different bonds. 16,000 different bonds with one purchase. In simpler terms, this means that a single euro is distributed across a vast array of 16,000 different bonds, each representing a small fraction of the total investment. So that is a huge amount of risk diversification. The same applies to VT. VT is one of, as far as I know, actually the largest trackers, the largest stock fund that follows the most positions. Namely, more than 9,000 different stocks spread across the world. Well, the largest portion is in the United States, but still something like, 30-40% in Asia and Europe. And there are 9,000 different companies in it. So how risky is that really? It is a fact that both funds could still decline by 30-40% in the short term, maybe even more. Only for the very long term does it seem to be a relatively safe investment. You can't really say that completely, of course, but that is my personal opinion on how I see it. Then he says, so we put 30% in that, but you also want to invest 7.5% in gold because of those correlations, because of diversification. And then he says, okay, you also want to put 7.5% in commodities ETFs. And GLD is actually the ticker, so that's just what it's called. You enter the ticker, and then you can buy an ETF. And GLD is the ticker of a fund that tracks gold, and it is actually the largest fund in terms of capital. What do you mean by capital? So the amount of money in it, and the larger that amount, the more liquid it is. This means you can buy or sell more quickly if you want to. So that is important, and that's why this fund, he mentions the commodities ETF with the ticker GSG. This fund includes energy, agriculture, metals, and livestock, specifically live cattle. So that represents a completely different sector, and they complement each other. Of course, this is an all-weather portfolio, and he provides these percentages totaling 100%, and you can play around with them yourself. What I would not do is to invest too much in gold and commodities, even if it is diversified. If I were in that position, I would invest in these two. However, I am a high-risk investor, and in the long term, I know myself. I know I can hold for the long term, so I set this to 0. Because yes, I am not going to invest in bonds. But even in that case, I still get about 15% return. So in this case, I can allocate 85% to just this fund. Stock fund. It contains 9,000 different stocks. And if I do that, supplemented with these two, I still achieve a return of 6.9%, which is relatively good. And so you actually have a lot of different options that you can do with the all-weather portfolio. But as an advanced investor, I have criticism of that. And you don't have to believe me, but you can believe a real advanced investor, namely one of the best investors in the world, and his name is Warren Buffett. And he actually says what a lot of people dare not say, and that is very simply the truth. If you are an advanced investor and you have knowledge of the matter, why would you buy 9,000 different stocks? It's not exactly what he said, but he mentions that if you are an advanced investor, it is much better to adopt a focused approach, and that means you are going to invest in just a handful of stocks, only 15, maybe 20 stocks, and you only buy the best companies because you know all the companies that are available. That is already one limitation or challenge, and you can select the best stocks from all those companies in all those sectors. There are very few people who can do that. Essentially, he is right. If you are really good at something, then it doesn't make sense to spread yourself too thin. If you are really good at something, then you just know. Like Max Verstappen, I can take that corner at 200 kilometers per hour or 300. How fast is it? Instead of when I get into that car, yes, then I drive it at 50 kilometers per hour, but it can go much harder and much faster because it knows what it is capable of. And it's the same with investing. And therefore, my personal opinion and criticism of this portfolio is that there is too much diversification. You also have something like buying too much. 9,000 shares in a fund sounds really good. If you want an all-weather portfolio for the purely long term, where you want to realize volatility, then this is perfect. Well, not perfect, but it's really good. And then you just have to adopt this to your party and carry on with it. Only if you know that you have the chance to achieve higher returns without taking much more risk, then it's just something you have to do, I think. That's my personal opinion. Therefore, you can replace this ETF and this ETF with the bonds, with an ETF that contains, for example, only 1,000 stocks. 1,000 stocks is less than 90,000, that's true, but there are still 1,000 companies publicly traded. That's still a lot. You see, that's my criticism. Yes, you're missing out on the chance for higher returns. Hey, it's great that you're watching Happy Investors. For what? Thanks. If you go to our website, happyinvestors.nl, you will find the free ebooks. Don't forget to download your free copy, such as the ETF book, which explains exactly how to invest in ETFs. Our free wealth calculation tool is highly sought after. You can also find some other downloads here. Additionally, on our website, happyinvestors.nl, you will find our demonstrably higher returns than the S&P 500 and the AEX. For example, our growth stocks are currently up 150% in just 1 year. Another limitation I find is that there are, of course, many non-sustainable investments included. This course happens to be about sustainable investing. Sustainable naturally for long-term success, but also if you want to invest in ESG, for example, so sustainable stocks. In such a large ETF, there are, of course, many non-sustainable companies. For example, the Vanguard World Stock ETF provides a lot of diversification, but it does not distinguish between oil companies or companies that do everything they can to alleviate poverty, as an example. So that is a criticism. Another point is less exposure in real estate. There are real estate companies in these funds, but not really real estate funds. So you could actually still improve in combination with second point, lack of non-listed assets. And actually, by combining these two, real estate and non-listed assets, what do we get? Namely, non-listed real estate funds. And in the Netherlands, I personally think there are some quite interesting non-listed real estate funds that still achieve a dividend of about 6.5% to 8.5%. 8.5% is really at the top end and 6.5% at the bottom. So assume, for example, a 7% dividend minus the costs, with dividend minus the costs. And then that actually makes a nice addition to this. And you could, for example, also make it 5%. But then you do need to include real estate funds. And the advantage of that is that they are not publicly traded. So they do not have price volatility. They can go bankrupt. Anything can happen that puts them at risk. That is correct. However, everything here is risky. So, in the right context, you do spread risks. So that's how you should actually see it. That would be a nice addition. And also crowdfunding, which I already mentioned, is a nice addition to this. P2P lending is a nice addition to this that is not publicly traded. So that could be an area for improvement. On the other hand, the all-weather portfolio is not designed to be perfect, nor is it made to achieve the highest returns. No. The all-weather portfolio is designed simply for people who want to invest money and achieve nice returns, but not very high ones. Much more importantly, they want to take no or less risk. And with this, you do take a risk, but we can say that the risk is somewhat limited. So that is the advantage of an all-weather portfolio. Plus, the addition of gold ETFs and commodity ETFs is very good, as they can rise significantly at times when stocks and bonds are falling. However, at other times when stocks and bonds are rising, those two can remain stable or decline. So those 2 or 4 asset class groups complement each other nicely, and as a result, you actually achieve sustainable wealth accumulation. This was the all-weather portfolio. It is actually applicable for anyone who wants to invest somewhat passively. And as I already said, with the monthly contribution or during the dip, you can possibly benefit extra from that. The last small addition is that you could set that cash position in such an all-weather portfolio a bit lower, because you are really doing it for pure long-term and you only invest money that you can afford to lose 100%. Great. This was the all-weather portfolio. Thank you for watching.